Hi, good afternoon. Thank you for being here with us today. A bit of background on Blackpeak first before I turn to my panelists to introduce themselves and their firms. Blackpeak is an investigative research firm that was originally founded in Asia and which has developed capabilities globally. We specialize in due diligence and business intelligence and investigations. Most of our clients are financial investors and other financial services firms, and we'll help them throughout the investment cycle from the very early stages, due diligence checks up to the exit, which sometimes involves problem solving and dispute resolution support. So, Nick, maybe if you would like to start introducing yourself and Navis.
Sure. So I'm one of the founders and managing partners of Navis. We started in private equity in 1998, and I just realized as I was talking to some of my fellow panelists that I think this is the 21st or 22nd time I've been at an AVCJ event. So it makes me feel old. And maybe I am old because we're investing out of Navis 9 now. It's our 9th fund. We invest mostly in Southeast Asia, but also Australia, New Zealand, Hong Kong. We focus on areas that we've come to really like over time: healthcare, education, software, consumer packaged goods, food, and so on. And for the first time in our history, beyond just the pure sort of flagship private equity product that we have, which is essentially built around taking control and growing in this part of the world, we're also just launching our first ever private credit fund. And with that, I'll hand over to...
Latif. Thank you. Yeah. Hi, everybody. Latif Gill from CVC. I think this is my 5th year speaking at this conference. They always give me the post-lunch graveyard shift, so I think our job is to keep you awake. CVC Capital, I'm sure you've all heard of. We're obviously one of the largest global private equity firms. We have a $4.5 billion fund, which is Asia Fund number 5. We are currently fundraising for $6 billion for Asia Fund number 6. I've been with the firm for 8 years. I'm a partner in the firm. I'm on the board of 7 of our portfolio companies across the region. We've done, I think, more than 20 deals now in Southeast Asia. Touch wood, never lost money on a single deal. We're very proud of that record and hope that continues. And very excited to be here as part of the panel today.
Good afternoon, everyone. Thanks for joining us. I'm the CEO for BMS in Asia. BMS is an insurance broking firm headquartered out of London, of the UK, where we specialize in specialist insurances that suits the region in which we operate. In the Asia context, we specialize in M&A insurance, which is the reason I'm here to speak a little bit about that. And effectively, that's a look of the use of insurance to transfer risk in an M&A transaction to alternative capital, like the insurance world, for example. So I'll be speaking a little bit about that, and over to Joshua.
Yeah. Hi, I'm Joshua Maxey. I'm one of the founders of Third Bridge. We're one of the largest primary research firms globally. We employ north of 1,000 people. Specifically to Asia, we have 4 different offices, including India as well. And we work predominantly with the buy side, so private equity, hedge funds, mutual funds, credit investors, and the large management consulting firms. I'll be here obviously to talk a bit more about some of the trends we've been seeing in due diligence work that we do for our clients. And yeah, over to you.
So good afternoon, everyone. I'm Alejandro Plaza, head of private equity at SESAMm. Don't have as much experience as my other fellow panelists. It's my first year here. SESAMm is a French fintech that specializes into natural language processing. So we have access to a data lake that is around 20 billion articles, and we can extract data for investment professionals, from social discussions to mainstream news and specialized blogs. We have specialized solutions as well for due diligence that we'll get into. So yeah.
Thanks, everyone. So a lot of us in this room have spent a number of hours over the past 2 years reflecting on how the pandemic and more recently Russia's war in Ukraine and the escalation of tensions between China and the United States, how all of this have changed or rather accelerated some of the trends that were already long in the making and contribute to shape our new world order, or rather we should say disorder, I guess. And so among these trends, is certain disengagement from globalization, even though the world has never been so connected, interconnected, and some kind of returns to nationalism and regionalism, as well as, of course, our relationship to technology, which, you know, in a tech-driven world where we need to be resilient in front of constant innovations and disruptions. So we would like to focus the next 45 minutes that we have together to discuss, you know, these changes specific to the M&A due diligence space. So before you close your transaction, when you do your due diligence. And I would like to dive into the discussion with this first overview question for each of the panelists about, you know, what are the key changes and trends that each of you in your respective world have been seeing in the way we think of due diligence and in the way we implement due diligence in practice. So perhaps we can again start down the line for...
Sure. Well, when Navis first started investing over 20 years ago, my founders and I had not had an investment background. We'd come from the Boston Consulting Group, so we had a management consulting background. So we didn't have a sort of playbook of processes about how to go through due diligence, for example. So we learned sometimes by mistake. And when we made a mistake, we would, you know, adapt and change. I would probably just sort of talk about a little bit of that transition and then maybe a little bit sort of from COVID and post-COVID. I think the first great insight is that you can never know enough about the people that you're about to invest in or the company or the industry that you're about to invest in. I think that in the early days, due diligence used to be considered a tick-the-box kind of exercise that you did at the very end of the process. So the deal team would go off and get incredibly excited about this company, this management team, they're great, they'd build a model, it was going to give us a 3x return. Everybody is deeply pregnant with the idea of deploying capital. The deal team knows it's getting a big bonus at the end of the year. Me as one of the investment committee members are feeling great because we're deploying capital and we're getting closer to, you know, raising our new fund. And of course, when due diligence is done as a tick-the-box exercise at the last minute, inconvenient truths get revealed, and it's really frustrating. So first of all, you waste a lot of time, you know, or getting excited about the upside, and when you get problems that come up late in the day, you have a moral dilemma. Everybody does, not as a firm so much, but individuals on a deal team. Those guys who are excited about getting their year-end bonus because they've done a good deal, I mean, how much are they really going to share about a problem that they've uncovered? Are they really going to hedge a little bit about how they describe it to the investment committee and so on? So the idea of starting due diligence really early was a very important insight to us. I think the other thing is that we also sort of came to think of, well, we started thinking that due diligence was a cost. It's cost us money, we have to use, and we do use people like Black Peak. We use SESAMm, by the way, and we've also used Sandra in her previous job. So the fact that, you know, they're on this panel and we're talking about new trends in due diligence gives me comfort that we've been working with them for a long time, so we must be doing something roughly right. But the idea that it's not just a sort of a cost center activity, but that actually through due diligence you can get insights that can allow you to build a little bit more value in your portfolio company. So it's not just about mitigating risk, it's also about uncovering insights that allow you to drive something extra into the business model and so on. I think I won't hog the microphone, so I'll stop without going to the end of what we might perhaps cover a little bit later on. But one of perhaps the biggest insights we had along the way was that you can have a great company in an industry with tailwinds, and it's wonderful, but if the integrity of the people that you're partnering with is not right, it doesn't matter how good the industry, how good the company is, you're going to really run into trouble. And so one of the things now that we front load very, very early is a very quick but super deep dive into the integrity characteristics of the individuals that we're going to be partnering with, and also the business practices that are endemic to that particular company. And so nowadays, of course, if bribery is part of the business model, I mean, that is a massive kill sign that is revealed very, very early in the process before we've gone too far. Let me stop there.
I think for us, the first thing I would say is the number of DD requirements has massively grown. If I look back 8 years ago, we did the traditional commercial, financial, legal due diligence. Now we've added on a whole number of new streams, from ESG to operational DD, to IT DD, to compliance, to background checks. So the raft of streams of work, the number of partners required on every single deal, and the complexity has massively grown. Having said that, the DD timeframes, though, have not got any longer. Actually, they're probably still as short as they ever have been, if not shorter. So within that 6 to 8 week time frame, how do you manage all of those different streams of work in what is, I think, businesses in Asia which are now even more complex? I mean, if you are mono country like Softex, our personal hygiene business in Indonesia, 99% of the revenue was in Indonesia. It was relatively easy to diligence with exclusivity. On the other hand, we did the deal on a bathing ape, which was a complex carve-out and take private in Hong Kong, and it was 35% of the revenue comes from outside of Asia. So dealing with those complexities, I think, is becoming much more challenging than it ever has done. So I think the important thing is internally, we have to have strong internal communication, a strong IC with intellectual honesty, reviewing managing partners that sit on the deal and have independence. Those are some of the checks and balances that we need to have to make sure that we're doing the right things in this more complex environment.
From an insurance advisor's perspective, and because our role is both on the due diligence side as well as pre-signing how to transfer some of these risks that are identified in DD, we see two big trends. The first is insurance DD has never become, or has never been actually, foremost on anyone's minds when doing DD. It's not a stream that they think about consciously. But with all the recent changes in the world as we've seen it, right, national catastrophes, war, climate change, etc., insurance and how it is an integral part of the operations of a business has suddenly become some foremost on a lot of our deal team's minds. And we get engaged much early on in the process in terms of at least analyzing whether an insurance is fit for purpose, whether it's actually in place. In some parts of the world across Asia, it might not actually even be in place, it's all self-insured. Is that realistic and reasonable today? And also to identify if some of these risks are still insurable. As a result of what's happened in the last 3 years, insurance companies having lost money or having identified risks that they can no longer insure, as you go into the business, what you think might be an insurable risk is no longer insurable, and then what? How do you price that risk and address that? So that's a big trend that we've seen, insurance DD coming up forefront. But on the other hand, the team that is with BMS today, we help transfer some of these risks that have been identified during DD. And that conversations come up earlier as well. Right? How do you use insurance capital and alternative capital in the context of an M&A transaction? How do you transfer those risks alternatively elsewhere? Certain insurable risks are transferable, tax risk, reps and warranties risk, and how do you then make that as part of your overall process? So those are the two key trends that we've seen. Over to you.
Without giving a history lesson on sort of primary research, and I guess I've been in this industry for about 2 decades now, I think the change really happened in 2007 when you saw a switch from public markets into the private sector, private equity investing. And back then it was really more about expert networks. So, can we put a framework around actually our interaction with experts, sourcing more experts. And as similar to what Atif said, the timelines were getting constrained, shorter and shorter. So the pain points for our clients were actually getting exacerbated more and more. And I think over in this region as well, people had very strong networks themselves, but all of a sudden, when you're looking at a business that's globally exposed and you need to speak to 10 buyers or suppliers, all of a sudden you need access to those experts. What's really changed in the last 15 years, I would say, is that we've seen more and more, certainly from our perspective, more content being generated and innovative ways that our clients are using experts. So the insights those human insights that they have. We started a transcripts business 7 years ago where we're actually leading those interviews ourselves, and clients are consuming that more and more in the early stages of research. But beyond that, there's survey work that they're doing. And I think during the COVID crisis, we saw a huge uptick in demand from clients who needed to tap into the experts to give them more insights into how to navigate and understand some of these really complex situations that were occurring. And I think at the beginning of this year, for example, you saw a lot of demand for clients trying to understand, for example, supply chain exposure, because all of a sudden this presented a whole new challenge. And I think now, as we're starting to see some of the deal activity, especially on the new side, weighing off a little bit, they're now thinking more around portfolio work, value creation work, add-ons. So there's more innovative ways I think our clients are using experts and those human insights to help them make better investment decisions ultimately. So, yeah.
Yeah, and at SESAMm, we've identified basically 3 key changes over the past few years. The first one being speed, in various forms actually. So the deal flow has been accelerating for firms. Like we conduct more deals on a yearly basis. The time frames of DD have shortened, and also the speed in the growth of information. Actually making sense of all the information in that time frame is not possible manually anymore for investment firms, and you need a very robust data science strategy at the core of your initiative if you want to be sort of accurate and stay on top of the competition as well. When you battle for a deal, you don't get exclusivity as easy as you did in the past years. So speed is very key there in the action, and as well how deal flow progresses. The second key change we've seen is basically in terms of the scope of DD, where previously you had some traditional tracks in terms of accounting, in terms of commercial, supply chain, legal. Now we started looking at companies in very broad angles. One of those is obviously ESG. We look now at how a company is making a sustainable impact on society through their business practices, and also corporate governance. So those are things that are not easily disclosed in a data room, and that you need actually expertise and usually data science to analyze massive data and get trends into those particularities. The third key change we've seen as well is around basically the importance of macro risks. So we've seen how intertwined sort of different subsidiaries are now in companies. And for example, we're working closely with a European bank that were trying to map their asset portfolio and also sort of the lending book to any potential Ukrainian risks. And so to do that again at the massive level of different assets and different businesses they lend money to, is not possible manually. So that is another one, sort of how you map accurately macro risks, be it in your business or at the due diligence level.
Thank you. So I think we all agree that the scope of work of the due diligence, in terms of work streams, but also in terms of possibilities, and I really like the comment that you made, Nick, about the change of perception for the due diligence being a cost center and a compliance-driven exercise up to being something that can actually add value to your deal and enable you to identify some information that you can leverage in your discussions. I think it's quite a nice shift, because it means we're not only here to identify risks, but also look at how to maximize the opportunities. The other thing which is quite interesting is the growing importance of geopolitics and the macro-level environment, which has always been a key component of risk assessment, because you can't just look at an investment target in isolation from its wider environment, right? But how nowadays, how has geopolitics really changed the way, or has it really changed the way that you, as GPs, as asset managers, you think of the assets themselves and of how to conduct the risk assessment on these assets? So that's a question more for Nick and Atif here.
Please go ahead.
Okay. Well, of course, it's been a big deal. I mean, I think before COVID and before the invasion of Ukraine, we sort of took the global supply chain for granted. It was incredibly efficient. We have factories in China, factories in Southeast Asia that are the factories for the whole of the world, and they make goods. The ecosystem around them creates little components. These are built up into sub-assemblies, assemblies, finished products, very efficient. They get shipped with very short order delivery times to points of demand all around the world. And we took it for granted that the shipping time of a container was X, that the cost of going from Singapore to Rotterdam or Long Beach was Y. And you never sort of felt that that was a thing that you really had to analyze. What volatility could you find in terms of time to market or cost of getting to market? And suddenly, you know, we all know how silly the supposition was that that is a sort of constant state and that it, you know, can be taken for granted. I think what's interesting right now is the fact that obviously there is I'm going to talk more about the tension between China and the US, or China and the Western world, because it's very clear sitting here in Southeast Asia that Southeast Asia is probably going to be a pretty big beneficiary of that tension. The reason is that the industrial ecosystem that supplies the rest of the world actually started in Southeast Asia in the late 70s and early 80s. And in those days, we had the tiger economies, which were Singapore, Malaysia, Thailand, and to a lesser extent then the Philippines, not really Indonesia back then. And that was the original factory to the world. And then, of course, China, with lower labor costs and more labor and a bigger domestic market, sort of copied and built on that ecosystem. And together, this ecosystem sort of coexists. And you have lots and lots of companies that have a factory in Shenzhen, but a factory in Malaysia, and a factory in the Philippines. So it sort of spreads cross-border. But of course, now, purchasing managers that never thought about you know, the issue of sourcing from one particular country are looking to have a much more diversified source of supply. Where do they look? Well, people talk about nearshoring, right? But I can assure you that nearshoring, so in other words, a continental European company suddenly finding all of the components or the finished products that it's looking for are suddenly available in Eastern Europe, it's not going to happen. It takes decades and decades and decades for the ecosystem of all the little suppliers, fourth tier, third tier, second tier, first tier, all of those things, the skills, the people that are required to make it work, takes decades to build. So although nearshoring is a very nice political aspiration, it's not going to happen. And where is the only other factory to the rest of the world? It really is in Southeast Asia. Probably 80% of the products and services that are going to get diverted out of China. Yes, there's a little bit in Mexico for auto parts. And yes, Eastern Europe's good for refrigerators, you know, for example. But the bulk of it is going to come our way. And so if you're investing now in a business that is a Southeast Asian-based business, which is supplying the rest of the world, a very interesting piece of upside due diligence is really to work through, in this particular instance, how much is likely to get diverted from China, how much of that will we likely capture in Southeast Asia, and how much, you know, and all the knock-on effects of that. Should we be adding how much more capacity to our factory? Do we need to hire more people? Do we need to beef up our supplier relationships to make sure that we're getting the chips that we need if they're in short supply? So to me, there has been a 180-degree change, both in the risk of supply chain disruptions, but also in the opportunity as we sort of sit here in Southeast Asia.
Yeah, I fully agree. I think we look at it in three ways. I think number one, a widening sector impact. I think historically we would look at areas like mining or energy or commodities as key areas in the bullseye of geopolitical risk. I think the number of sectors that now impacts is much wider. We have to think more carefully about mono-country. We have to think carefully about how that looks across our portfolio. We have to think carefully about add-ons. And I think no one at this stage knows what the hell will happen in China. And a lot of our businesses obviously have some type of China linkage to them. So I think that level of uncertainty is there. I think the second area is supply chain around electronic commerce or electronic industry. So digital technologies have obviously been transversal. So people have focused on hardware, software, services as a big play in terms of equity investment. And we have done the same. We made a big play on Razer, which is the largest gaming lifestyle company globally. But 60% of that revenue came from outside of Asia. And so we've been obviously hit with, too much stock sitting in the pipeline of a messed up supply chain, but then also challenging consumer demand in a geography that isn't very native to us in terms of understanding. And I don't think anyone knows at the moment how long it will take for the EU to recover from the current challenges on consumer sentiment. And I think the third thing is around cybersecurity and data protection. I think the RCEP agreement in 2020 is starting to put far more controls around data privacy than we've ever seen previously, and I think it'll be moving more towards the sort of European model. So understanding those three areas and how they impact the deals that we look at is something that we're spending a lot of time on. We also have a macro risk tracker, so we take all of our current portfolio companies and new deals through the tracker to be able to evaluate, is this a deal that we want to do? Is this a portfolio company that needs urgent surgery? I think an example of that would be Garuda Food, where in January we saw raw material price increases of 20%, sugar, palm oil, chocolate, wheat flour. So we set up a SWAT team in January. We looked at substitution of raw materials, yield improvements, how do we take cost out of our manufacturing facilities. If we'd done nothing, we'd have lost 35% of our EBITDA. By taking proactive action, putting price increases through, we're now 6% above budget for the year. So we use that learning to take that back into new deals and evaluate whether those things make sense. And it's probably the most complex time, I think, for PE investors at this stage.
Thanks. You mentioned data privacy is going to become a central issue, and I think it's especially true for Southeast Asia. This year we've seen a number of countries here passing new laws or implementing, enforcing data privacy protection regimes, and that's, we're only at the infancy here on the implementation stage and enforcement, and I think we are going to see the first instances of how these laws are being executed and enforced. But maybe we could come back on the supply chains, because that's something that both of you have mentioned. And Joshua, you mentioned earlier that you've been doing quite a bit of work in terms of mapping and identifying all the actors throughout the supply chains for your clients. So could you share with us how this is being done in an efficient manner these days, and how this adds up to the already bigger scope of the due diligence work?
Yeah. I mean, I would say it was probably at its height sort of at the beginning of the year, when people were really scrambling to try and understand supply chains in a bit more detail. One of the things we actually created because of this was a product that maps the value chains of companies. So we visually now show the value chain around any business, and we're using, again, our experts to help inform that. So, and that was really because clients were pulling us in that direction. So they were trying to understand, okay, if this happens, on that part of the supply chain, what impact is it going to have, across the different parts of the value chain? And we've seen a lot more usage, certainly, from clients on this product. And I think it's a massive topic for our clients. And I think it's not going to go away anytime soon. And so yeah, I mean, all I can say is that there's just a lot of demand for that. Yeah.
Thank you. That's a really interesting issue. And perhaps before we move on, we should pause and ask if there are any questions from the audience at this stage, or from the online chat box. Okay, so we'll just continue then. So in an even more complex world where everything is interconnected, there are new regulations all the time, changes in regulations, we need to be ready to face or expect the unexpected. So the world is more complex. What are the tools that are available for private equity professionals to do, a better due diligence upfront, and especially in terms of technology? How has this changed? Is this really a game changer? How has this changed the way we conduct the due diligence in practice? So perhaps we can start with Alejandro on since this is the focus of his company, using artificial intelligence and...
Absolutely. So coming back to sort of the one of the key changes was speed, right? And how do we then act on that proactively at sort of before we even engage in due diligence? And we've seen investment profession being sort of a, maybe in the past, a bit of a conservative industry, and maybe behind the curve vis-a-vis technology adoption. And we see that is massively changing, actually. Something that is probably very familiar for everyone in the room is how efficient public markets are, right? There is that hypothesis of market efficiency, and everything is sort of baked in the price. And we see that trend actually trickle down to private markets, where more and more information is available online. We can make sense of it at an aggregate level, and so that hypothesis of market efficiency also translate to the private equity world. And one practical example, we've been actually in the past weeks finalizing a product for a top-tier PE fund, where we've integrated every data provider into one CRM. So that is super useful in terms of getting all your information mapped into the one platform. So when you enter a deal into the pipeline at the very early stage, then you can get your financial data trickled from whatever sort of data provider you're getting. And then you can also get sort of alternative reports on sentiment on that company, on ESG risks, and on virality contents as well. And that approach sort of stays with the deal, right? As the deal progresses into advanced due diligence, you get a clear mapping of what are the areas you should be looking into. Because you've done the work previously and you've done it at an automated level, you're actually starting with an advantage vis-a-vis other people that are just sort of getting their hands on evaluating the deal. And you have a clear sort of roadmap on, okay, I'm going to look at these items at the due diligence level. Then you can ask as well for sort of more specialized reports. And as the deal closes down, within the same tool, you can start monitoring that asset, right? And getting quarterly updates on how that is doing to then time exit efficiently. So that is a practical example on how now we have a lot of tools to look at different things at a portfolio level, and how aggregated those help you sort of get a clear idea. And that then gets as well into a trend that we're just seeing the beginning of it, which is predictive models. So one of our clients as well has done that with Mother Brain, so Equity. They have a mapping tool whereby helping sort through deals that have been done in the past on the private space, both internally and also publicly. They're able to sort of come up with a valuation target for any company at the seed stage or Series A stage. So that is the valuation, and we think that will happen as well at the due diligence level, where you know you've done 100, 200, thousands of deals, and then you know exactly based on some of the company metrics where the due diligence is going to lead you, and what are sort of the main points you should pay attention to. So those trends, like sort of getting prepared at the level, being centralized, and then that trickling down into predictive models.
On the sentiment analysis field, could you give us a practical example of how this could help anticipate, how this could be seen as a deal breaker, and how could it anticipate fall down of shares or crisis?
No, absolutely. So two very specific examples, and they are very top of the news. So FTX, the crypto exchange that is now crumbling, filing for bankruptcy. We actually saw in our tool the growth of negative sentiment picking up very severely 3 weeks before the news broke out. So you can clearly see in one of the data, and we published a study on LinkedIn about that. We can see the sentiment really sort of getting more and more negative as the news are breaking down about bankruptcy. So that really helps you sort of stay on top of trends and predict any movements. Another one is Teleperformance, which is sort of a back office provider that is listed in the Paris stock market. They had actually a very sort of obscure probe into their Colombian subsidiary that was very, very tame in the news, but it's actually a TikTok documentary that went out by workers in Colombia, publishing about like $10 working days, very violent working conditions. And that was a month before the news broke out and the stock price pummeled like 30. And that news was identified, that TikTok documentary was identified by our tool 3 weeks in advance. So that's sort of the examples of how you can, by monitoring your portfolios in that fashion, stay ahead of the trend.
Actually, I think just on a similar example, but on a more sort of uplifting way of using it, because there is so much data out there now. The question is, you can also go very surgical. And just to give an example of when we used Alejandro's company recently, this was vendor due diligence. So we were getting ready to sell a business that we owned, which is in the vaccine cold chain. And we bought it well before COVID. And of course, the vaccine cold chain until COVID had primarily been used to get vaccines to difficult parts of the world, to children that live in sub-Saharan Africa, in parts of Latin America, and so on. And one of the key drivers of demand for the vaccine cold chain, of course, is not the needs of the children, because those are massive. It's the amount of money that donors and donor governments are prepared to give. And so that sentiment about how much money, how much funding to give is an important predictor of the market size for the vaccine cold chain. Now, of course, when COVID hit, demand for vaccine cold chain equipment skyrocketed. And as vendors of this company, we had to convince the buyer that this wasn't a blip, that this was actually a trend that was going to continue to build. And the way we did it was through vendor due diligence, using Alejandro's firm, where we could start to show, pre-COVID, the amount of discussion about the vaccine cold chain, almost nothing. It was like a problem that was a long way away, didn't really affect people. And we could then show the build-up of all the articles that were coming out, academic research, government statements, statements of funding, and we could show, look, the world has really changed, and therefore, the strong assertion that we could make with this data was, this isn't a blip. You don't have to worry about overpaying, based on 2021 earnings. This is going to continue right into the future. And that, I would say, that made a very material difference to our ability to sell that company at the value we did. So I'm very grateful to SESAMm for that.
Thank you, Nicholas.
And it was a tiny amount of money that we paid, by the way. It was, it was worth tens of millions of dollars to us. I want to invest in his company. It's all becoming clear to me. It's just fantastic.
He's got to charge you double.
Yeah. Actually, I think it should be free.
So you can increase your fees.
Absolutely, yeah, I'll take that to heart, yeah.
Advisory.
Mindful of the time, I'm going to ask again if any of you has any questions for our panel before I ask the last question. No? So once you've gone through the hurdles of risk assessment, you've done your due diligence report findings, you've identified the risk areas or the opportunities areas, you've already taken some actions to mitigate those risks and remediate. What else can you do to minimize your exposure? What are the latest de-risking approaches? What are the practical tips, more both tactical but also more strategic, that you can give us as practitioners on how to reduce the risk before the signing? So perhaps we could start with both of you, and I know Sandra has a very interesting point to make.
I think after you.
Sure, thank you. I think, look, number one is current trading. I think it's so difficult at the moment to kind of navigate through historical COVID impact, current challenges this year. What does that projection look like moving forward? I think we're going right up to the last minute on current trading and making go, no-go decisions. We've just pulled out of a deal recently because 60% of the revenue was coming out of China. There was a view from the shareholders that they were going to recover, but clearly that was not going to happen. So I think we're making calls on that up until the last minute. I think number two, we look at three things. We look at the attractiveness of the market, the quality of the asset, and the quality of the management team. And I think we're definitely deep diving on all those three. I know there's a lot of headhunters in the room. I see a few who will tell you that the CEO is the most important person. There's definitely a war on talent, and you have to find good management teams. So diligencing that team when you have limited access is absolutely critical, and the earlier you can put in the right people, the better. That gives you confidence. But there's a Harvard study done many years ago. They looked at 200 companies over 10 years, and they had 100 executives like you in the room, and they asked them, what's the most important thing? Is it the market? Is it the industry? Or is it the CEO? and all the CEOs put their hands up and said, it's the CEO, obviously. The reality is 70% of the success of those investments over 10 years was the market. So understanding the market, it's very hard to swim against that tide. So understanding that well, making sure it's as risk-proof as it could be, I think is one of the biggest things that we spend a lot of our time and energy on. And I think internally, I think it's very important in Asia to go around all of the deal team members and ask them what they think about the deal. Sometimes decisions are made top down, the big voices, no one wants to speak up against those bigger voices, but actually the junior guys know a lot more about what's happening on the deal than sometimes the senior guys do. So having that intellectual honesty, getting younger people to speak up, getting the deal team together to really have one solid point of view when they go to the IC, I think is very important. So I think those are some of the practical, strategic things that we look at.
I'll give 4 super quick practical tips. One is take more time during the due diligence. Fortunately, we don't do as many sort of short fuse deals, I think, as CVC. They're a little smaller in size and therefore often more proprietary. So we take a lot more time. And then take some more time still. Have a MAC clause for sure. We got out of a deal just before COVID. It was in riverboat cruising on the Mekong Delta. And it was literally a week before we were writing a $60 million check. And we had a bit of an arm wrestle for about a week, which was, well, COVID isn't really a MAC event. Of course, the vendor lost that argument. The second thing is put in an earnout, because it is very hard to judge today's trading. Is it a run rate? Is it a blip? Is it not a blip? So put in an earnout component, and finally, I'd say use W&I insurance just to cover the risks that some of which you know and some of which you don't know.
Yeah, plug for me. Thank you, Nick. Yeah, exactly. I think once the DD is done, from our perspective, what are the practical solutions? My old hat before joining BMS, I was a corporate M&A lawyer. You kind of do all the DD. And then as a lawyer, you write all the reps and warranties, but the solution are not there practically, right? It's a piece of paper. And what's a piece of paper worth if your seller is a financial institution that is going to be wound up, or an SPV, or exiting the business altogether, or an individual? So I think the way we look at it and where we come in sort of BMS is to help advise on the transaction as to where these buckets of risk sit and how you can use alternative risk transfer solutions and allocate them. Right, so if you've got identified risks that are contingent in nature, think about contingent insurance, right? Say tax insurance. If you identified a tax problem that you can't allocate between buyers and sellers, you're just locking horns and negotiating. Think of insurance as an alternative use of that capital to ring fence that risk. If you've got unidentified risks, so the what if, the black swan, I've done all my due diligence, I've got all my team on, but there's just some information in there that I don't know about, right? Either because the seller hasn't given it to you, or it's just sitting somewhere and not crystallized. A tax audit post-completion is a classic example. You come in, you have a big check, who bears that? So the unidentified risk is where W&I insurance, warranty and indemnity insurance could come in. It's basically essentially transferring risk between sellers and buyers as to post-closing, who bears breaches of reps and warranties to the insurance world. So that's a solution from a practical perspective that fascinated me as an ex-lawyer and caused me to move into insurance. Is now my new career. So yeah, thank you, Nick.
Last call for questions before we wrap up the session. No? Then thank you very much, everyone, for sharing your time and insights with us, and thank you to the audience for listening.